The JMF Advisors Show is a podcast for business owners, C-suite executives, and entrepreneurs who are looking to build, grow, or even exit a business.
We bring in some of our best financial advisors to interview experts on business best practices, hot topics, and sprinkle in some tax and accounting help.
If you're a business owner, startup founder, CFO, or just starting your side hustle, this podcast is for you. All right. Well, welcome back to the JMF Advisors Show. This is Bobby Bragg, your host today, and I'm here with Carl Jamison. Welcome, Carl.
Thanks. Great to be back.
Yeah, we're glad to have you back. Carl and I did at least one podcast before. I think that may have been season number 1. We're all the way to season 3. Can you believe it?
I can't believe it, but I can believe that we both don't remember which season it was.
That's right. No, everyone else is like, y'all have seasons? Well, that's just the way we're calling them.
That's right.
In ours.
Sounds good.
We've got new sound.
I see that.
Beautiful studio here in downtown Tuscaloosa. Seed Creative does a great job.
Absolutely, they do. Love coming here. Well,
today we want to talk a little bit about selling your business. So we're seeing a lot of activity around buying and selling businesses. You know, the baby boomers are getting to that age where they're either retiring out of their business.
I am one.
Yeah, there you go. He's on the younger edge.
Edge of that group, but
correct. Or you know, a lot of times part of the retirement strategy is to sell the business.
Yep.
So we're certainly seeing a lot of transactions and potential transactions around that. You know, 40% of all small businesses are owned by baby boomers in the U.S.
There will be a lot of opportunities for younger people to buy those businesses and carry them on and grow them and become entrepreneurs themselves. So,
Absolutely.
Yeah, a lot of opportunity out there.
Absolutely. 10,000 baby boomers are retiring daily right now. That's amazing.
I'm going to be one of those one day. Soon.
Well, we're glad we still have you here because then we can have. Maybe
here.
you could just be a podcast host from.
That'd be great.
Yeah, absolutely.
Maybe George could hire me on.
Yeah, that'd be awesome. So when we talk about selling your business, I mean, kind of even before that point, a lot of people say, "Hey, let's make sure everything's cleaned up before you even get to the point of." You know, bringing someone else in to help market your business or sell your business or bring in a potential owner. Let's talk a little bit about, you know, what that process looks like maybe in the year leading up to.
Well, it really needs to be a process before a year leading up to that. I mean, you need to have your financial house in order way before that. I mean, clean balance sheets, making sure that they're appropriately in order, in line with what your business is.
Right.
That could mean capitalization.
Right.
Your fixed asset or CapEx ratios. Certainly your accounts receivable, your current ratio, you know, your current assets versus all those need to be in order, but they need to be in order every year prior to that.
Right.
Operationally, you know, you need to be profitable.
Yeah.
You need one set of books that shows the real deal.
Right.
And those need to be, you know, you need to maximize profits all along the way.
Right.
In my opinion, because you can't show a 1-year picture to these valuation experts or potential buyers. You know, you need audited books are the best.
Right.
Because those are thought of more highly than non-audited financial statements.
Yes.
And we've had clients in the past where they had no reason to have an audited financial statement. Banks didn't require it. Regulators didn't require it. Nobody required it, but they wanted it because they knew that at some point they were going to sell their business, and they thought that would bring more value, higher selling price.
Yes.
When they did sell.
Right.
So.
And I think it adds just a financial discipline to your leadership team as well. When you when you know you're going through that, I think it says a lot to buyers already.
Yep.
And then, you know, you never see, or I don't ever see, you're never valued just off of the last year's.
No.
EBITDA. A lot of people always talk about, they're looking at 3 years minimum. Of EBITDA or net income or you name it for these valuation methods. So that's another reason to make sure you're good and house is in order.
Your house needs to be in order every year.
Yeah.
Not just the year or two before you're selling.
Right.
Of course, on valuations, that's a whole nother subject that we could spend a lot of time on and probably will.
Yeah.
But, I've seen them where they take 5 years and take the high and low and drop them out, take averages. Kind of depends on your industry, but they're all looking at cash flow. Right?
Yeah.
Multiples of EBITDA.
That's right. For the most part, they're trying to figure out what they're going to, whether
much
it's discounted cash flows.
Yeah. How much cash is the business going to generate so that I can pay back
whatever
my purchase price?
That's right. That's right. So sort of almost the first question outside of what is the value of my company is how am I going to sell that? So is it an asset sale or a stock sale? You and I have kind of kidded about it. They always seem like somebody wants an asset sale, somebody wants a stock sale every time, and then everything's negotiable, isn't it, Carl?
Absolutely, it is. But I have yet to see one where the seller didn't want it to be a stock sale, and the buyer didn't want it to be a asset purchase.
Right.
And from the buyer's perspective on an asset purchase, those depreciable assets that they're purchasing, furniture and equipment, real estate, not the land, but buildings,
right,
rolling stock, all that stuff, they get a new step up, and then they can depreciate it when they start their
ownership. And then with bonus depreciation, this now,
you can write it off pretty fast, the short term assets. But then the seller, he has a recapture. Instead of paying tax on capital gains rates at 20%,
yep,
on his gain, her gain, the portion that's allocated to the 1245 property, the property that the seller has already depreciated.
Yep.
Okay, it's got to be recaptured, and that's at ordinary rates on those short-lived assets. You get a little better rate on buildings that have been depreciated over a longer period of time, but it's still got a 25% rate. So ordinary on 37 can be up to a 37% rate, 25 on real estate, buildings, and then 20% if you're a stock sale. So all that's negotiated between the buyer and the seller, not only in their price, but
right. So a $10 million sale is not always a $10 million sale, is what you're saying.
Not after tax.
Right.
Before tax, it's always the same.
Right.
But after tax, completely different.
Huge difference.
Yeah,
absolutely.
Could be. Depending on the mix of the allocation of the purchase price.
Right.
Which we'll get into in a minute.
Yeah, absolutely. So if you do an asset sale, the next question is, okay, we've got to agree on a purchase price allocation. Explain what that is for everybody. And let's just, since we said $10 million as the sale, let's just use that as round numbers. What does a purchase price allocation look like for, random company X, $10 million or whatever?
Well, obviously it depends on what industry they're in and how heavy they may be with capital assets.
Right.
They're a service company. They don't have a whole lot of capital assets. Most of that's going to be goodwill in your allocation. But a manufacturer, they're typically going to have a lot of
heavy investment in equipment and
exactly. So in that allocation, typically these deals are not. You don't count cash. The seller's going to keep their cash.
Right.
Typically, the seller's going to keep their debt too.
Yep.
Long-term debt, and so they're selling accounts receivable, inventory.
Yep.
Fixed assets, and then they let the accounts payable, other accrued liabilities, they'll net those
A little
into
working capital adjustment, right?
yeah,
there.
into the purchase price as well. So it just all depends on what those assets are,
Reasonably valued at
exactly. Your receivables, they may exclude receivables that are more than 120 days old.
Yeah.
They said, I'm not going to buy your bad receivables, right?
Yep.
Inventories, that's always a matter of valuation, depending on turns, how old some of that stuff is. You could
Right.
have some obsolete inventory that they don't want to buy.
Yep.
So it gets down to a valuation issue with all those items. And then fixed assets, I've seen people get appraisals.
Yeah.
Sometimes that's the last number. Of course, the last number you're getting to
Whatever you haven't accounted for and adding up all those other things.
is goodwill,
That's goodwill. That's right.
which the seller wants more goodwill at the end of the day than all those others
Right.
because that's capital gain. That's
Yep.
taxed at a lower rate.
Yep.
Again, the buyer wants as little goodwill as he
Right.
can because that's deductible over a much longer period of time than some of the fixed assets.
That's right. So again, I think my takeaway from that is everything's negotiable. Although, for the most part, a lot of these deals end up looking the same in structure.
Yep.
But you have to account for everybody's wants and needs in the transaction. And the price is one thing, but there are other little variables that end up changing what the bottom line is in your pocket if you're the seller, and then what it true cost is if you're the buyer.
Yeah, I have seen a lot of times where the buyer is telling the seller all along, well, it's a stock sale. We're going to buy stock. We're going to buy stock. And they kind of negotiate that price based on that because the seller in his mind thinking, okay, well, I'm selling stock, so I got some pretty cheap taxes here.
Yep.
20% Fed, whatever state you're in, obviously. Some states have income taxes like our state.
Yeah.
And then we get right up to the end and they say, oh, by the way, this is the buyer. Oh, by the way, we want to make a Section 338 H10 election. And the seller's going, what the hell is that?
Right.
Excuse me. Not sure I can say that. But and what that is an election that both the buyer and the seller can make to treat the stock sale as an asset sale for federal income tax purposes.
Yeah.
So then you get into the whole valuation thing that we just went over.
Yep.
And you can't say, well, I'll let him put whatever values they want to put on it, and I'll put my values on my assets, right?
That's not how that works.
Can't do that. No, can't do that. There's a form that both the buyer and the seller have to fill out and report to the IRS the allocation of that purchase price, sales price, into different classes of
Right.
assets.
Yep.
Class 1 is cash. Class 2, I think, are other cash-like items, CDs, marketable securities, those type thing. Class 3, I think, are receivables, trade receivables, notes receivables, all those. Class 4, I think, is inventory. Class 5 is your fixed assets. Class 6 assets are intangibles other than goodwill.
Right.
And
Like
then
trademark stuff.
that kind of
Costs,
stuff.
Yeah.
Yeah. And then your final class 7 is goodwill,
Right.
whatever's left. And you want that to be a positive,
Right.
because if it's a negative, you paid too much.
Right.
Right?
Yeah. So the IRS takes that form and says you're agreeing to it, and they're agreeing to it,
And that's how you have to allocate the sales price from the seller's perspective when you're measuring that gain that the different tax rates are applied to. So,
yeah, makes a big difference.
Yep.
For sure. Now, we started this conversation talking about some of those smaller businesses that potential retirees or baby boomers are selling out. A lot of folks now are looking at potentially seller financing or even installment sales.
Yep.
Both of those have similarities, I guess. So that that's a little bit different than say I'm going to give you $10 million today and walk away. Talk to me a little bit more about some of the intricacies of. Let's start with an installment sale.
Yeah, and I guess with the interest rate environment, not as favorable as it was
Yep.
what, 18 months ago?
Yeah, exactly. A year ago.
Those are probably could be more in play where the buyer and the seller agree, well, hey, I'll finance some of this sales price. I may can get a better rate from you than I might could get in the market, and you might could pay a better rate than what you can get in the market.
Right.
So
From a bank or other
exactly.
non-traditional lender.
And so to the seller's perspective, the buyer doesn't matter, right?
It's a cash flow analysis
Yeah.
from the buyer
Yeah.
perspective.
But the seller, he can recognize whatever gain he may have to the extent of the capital gain. I'll come back to that in a minute. As he collects the principal
Yep.
on the installment note that he gave when he sold it, right?
So a lot of times those installments are like, let's just say a 4-year, you're going to pay a monthly amount. Think of it like a mortgage, but a much shorter
Short term,
duration.
yeah. 60 months, I'll finance half the purchase price, whatever.
Right.
Interest, you're going to pay tax on the interest as you collect it at ordinary rates. The principal, again, you get to pay that gain as you collect the principal. So you don't have all the tax due in 1 year.
Yeah.
You can collect it as you're paid. Now, on hot assets, those are those assets that you've depreciated.
Right.
Anything that has ordinary gain associated with it
Right.
in the calculation of that gain in the sales, it's recognized whether you get the money or not in the year of the sale.
Right.
So don't think you can defer ordinary
Yeah.
ordinary income tax.
Right.
But that kind of helps spread the tax out, depending on how long you want to finance it.
That's right.
So
Yeah. So if you're the person selling the business, you're able to spread the tax effect
Yep.
of the sale out
Yep.
a little longer. You also, it may be a good, not everybody wants to get a lump sum of money. They'd rather, okay, let's spread it out
Yep.
over 5 years just for other reasons.
Yep.
And that does help. And, we also see things like I'm going to keep the building and you rent the building
Yep.
from me. So there's some strategies around that just from a, lifestyle and cash flow
Absolutely. And you
perspective.
mentioned the real estate play, if there's one. Sometimes those things are decided by who's buying your company.
Yeah.
Is it a strategic buyer,
Yeah.
which is somebody that knows your business, is kind of in your business and does the same thing, may have other facilities?
Right.
Or is it purely a financial buyer that all they're doing is buying cash flow,
Yep.
right?
Yep.
So some different perspectives.
That's right.
Your strategic buyer may want that real estate because
Yep.
they value it more so than maybe a financial buyer who sees it just as a
It may be just a cost to them, right?
exactly.
Yeah.
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 Rent.
Okay, so I think we touched any real cons. I guess a con to installment sales is you don't get all the money up front. But I think you kind of know.
Yeah,
that,
you
don't
got a risk that they walk, right?
you? Yeah,
Seen that too.
yeah. Or they
That's
run the
not
business
pretty.
into the ground in 3 years and
Yeah,
you're still
can't
waiting.
pay you. Yeah.
Yeah, those are obviously things you need.
And
to
you can get
price
as
in.
much security collateral as you can, but you're typically behind the primary lender.
Yeah.
So yeah, there's a risk
Yep.
to that.
Yeah, absolutely.
Good point.
I don't know any other cons you want to throw out there for either one of those.
Not that I can think of, but
Yeah.
if I just blurt something out in a minute
You'll know.
as you're talking about something else, you'll know that I thought of something.
There you go. So we get asked, so, what's the value of my business? And, sometimes when we get asked that, it's because they've already gotten an offer most of the time from a strategic. But
Yep.
there's enough capital in the private equity markets that there are just, hey, we're a financial
A lot
buyer.
of cash on the sidelines looking for cash flow, right?
So, yeah.
Yeah.
Certainly there are times when, people come to us and say, hey, I got an offer for X. What do you think? Which, there are all sorts of reasons for that. But, there are just flat out ways that companies are valued. And you mentioned earlier, we'll probably do an entire podcast on
Valuations.
with a valuation services company
Yeah,
that does
yeah.
that every day, all day.
Yeah.
But I mean, just on a high level, what are some of the things that you most often see from valuation types?
Typically we're looking at EBITDA multiples,
Yep.
where you start with your net income, some period of time, 3-year average, 5-year average, whatever. And then you work down in EBITDAs for earnings before interest, taxes, depreciation, and amortization. So
Right.
you're just getting down to a pure cash play, right?
Yep.
And then you may pull out or make adjustments for extraordinary items that may have happened in a year. For example, PPP
Yeah.
money people got, ERC,
Yep.
all these COVID incentives that businesses got. You pull those out because those are not reoccurring.
Right.
You're not going to get them again, right?
Yeah. Let's hope not. Well,
Yeah, yeah. So, you get down to that, and then you're playing with what does that multiple look like in your industry? And multiples are different and dependent on
Yeah.
what industry you're in. Some industries, it's a multiple on their revenue,
Yep.
right?
Yeah. A lot of professional services that don't have a lot of
Yep. Yep.
capital intensive
Yep.
needs. It really is a revenue play.
So there are all kind of ways to do it, and we work with valuation firms. We don't do valuations.
Yeah. I mean, there is an actual report that you can get.
Oh,
That is
absolutely.
a
Yeah.
valuation report. Which,
And-
again, if you're one of those, well, hey, I've got audited financials and we do all this other stuff, they probably would have before they go to market, they'll have a full valuation
yeah.
done.
Yeah, we can help them get an understanding of what their valuation might look like before
Yeah.
they get the actual report and before they go to market. Absolutely.
Yeah.
That's probably when if you're going to market, you're probably going to get your own valuation,
That's
right?
right. Because a
You have
lot
to
of
spend a
times
little
a seller will then also get their either own valuation.
Yeah.
Again,
Or
as
they have in-house people that
correct.
run the same numbers so that they know what they can pay for
Right.
this cash flow.
And there's sometimes a quality earnings report, which is similar to,
Yep.
it's probably a quasi audit of, okay, these are things I would add back or not add back to, an EBITDA number or a discounted cash flow
Yep.
number. All those.
Owner's compensation,
Yeah.
self-rental, those type things.
That's right. So all things to kind of consider when looking at valuing your business. So this is an area, I guess the thing that I would tell an owner that's looking to sell is, you've spent 30, 40 years of your life, 50 years of your life building this asset, and now somebody is offering to buy it, or you're looking for someone to buy it. I mean, this is not an area where you want to fly blind for sure.
No.
You want to get maximum value. You want to have a lot of people in your corner that can help you navigate not only the valuation question, but the taxation question.
Yep.
You'll then
Yep.
have retirement and estate planning issues. I mean, there's just a lot of things that you're going to sell a business once if you're lucky.
Yeah.
You may sell 2 businesses in your life, but I mean, it's not something you want to do every day or have done every day. So you want to bring in deep knowledge experts on that.
Yeah, and buyers are going to pay the least they can, and
Right.
obviously sellers are going to sell for the most they can. So there's that
Yeah.
a willing buyer, willing seller
Yep.
deal on fair market value, right?
Yep.
But we have instances where clients will say, "Well, what's my company worth?" Well, let's get a valuation. Well, I don't want to pay for that right now.
Yeah.
You tell me what it's worth. So we go through that exercise occasionally if we can, and
Yeah.
just take our experience in their industry, and we can certainly run the numbers.
Right.
But then as far as what are the multiples, I've got a firm that I'll call and say, "Look, I've got this company in this industry with this kind of cash flow.
Yep.
in today's market, what kind of multiple? Give me a range.
Yeah.
Can I throw out there to say, here's what I think it's worth?
Yeah. And they have benchmarks, and they keep it up to date on,
Absolutely.
XYZ industry is typically a 3 to 5 multiple. This other industry is normally 8 to 10. And I mean, obviously everybody's like, well, I want to rather be the 8 to 10 multiple than the 3 to 5. Well, you're not in the right industry for that. Again, that goes back to who is the acquirer. Sometimes a strategic will buy for other reasons outside of
Yep. Get in a new market, right?
Or you have a unique product that they don't have that really adds to their portfolio of things to sell. To
So once you get that value, that enterprise value, I think they call it.
Yep.
Then you have adjustments from that to come up with a net value, and one of them's debt.
Right.
If you got a lot of debt, you got to take that into consideration.
Yep.
Discounts. I mean, so yeah, we need to have a session on
that'd be a
how
good,
you value a business.
Right.
That'd
be a good full. That may be a very long
part two, part one, part two.
Yeah, absolutely. And normally when you are selling those businesses, you're going to see other components like a non-compete. So, so if you've owned a business for 20 years, 30 years, it's all you've ever done.
Yeah.
You can't sell your business and then go start the same business all over again most often.
No, most buyers would prefer that when they buy your business that they're not going to have to compete with you
Right.
The next week when you go start your own,
Right.
doing the same thing
Right.
with your old customers, right?
Then you're going to fight over who's going to get the
so
customer.
you'll see non-competes in there. Typically, they're 5 years. Geographic. You can get the attorneys in. That may be a whole other segment too.
Right.
What's in a buy-sell?
Yep.
Not buy-sell. Non-compete.
Yeah.
We'll talk about buy-sells in a minute. But yeah, it's just to prevent the seller from opening up and doing the same thing.
Yeah. The other thing you'll see in a lot of purchase agreements is, hey, the owner of that business may stay on for 2 years, 3 years. Sometimes it's consistent with that.
And they'll want to tie the seller into that commitment.
Yeah.
To stick around. Some of the management team do the same thing. But I have seen cases on that 5-year non-compete that on 5 year and 1 day, that seller started a new business.
Right.
Doing the same thing. So
that's right. Well, that's why, again, everything's negotiable in that deal, right? So they could have done some other time period if that was an issue. But you would hope, as if you were the buyer in that situation, you'd had 5 years.
You got
to
some
lock
period of
down.
time to make your money back. Right.
That's right. Yeah. So you mentioned buy-sell agreements. We do see those. I mean, typically that's well before any. It's really in an operating agreement before a purchase or anything like that.
Yeah, and that's when you got more than one owner, right?
So if you and I own a business, I pass away, you then have the right to purchase my half of the business, assuming we owned it 50-50, based on some
number that we have agreed to.
Right.
That could be that in our agreement it says we're going to have it valued by this valuation company every year.
Yep.
Or we pick a number.
Every year.
We know what it's worth.
Right.
But every year, okay, Bobby, this year is $1 million.
Right.
And for that whole next year, something happens to either one of us.
That's right. And it's either one of us happens, right?
Yeah.
So, and it's not always death. I mean, it could be
disability.
Disability, yeah.
And it's really to try and maintain the business and the relationship that the two owners that started it, that it continues that way.
Right.
That makes sense?
Yeah.
Not really.
Well, yeah, I mean, so if we're 50-50 partners and
I don't mean this ugly.
Yeah.
But I may not want to be in business with Amy.
I understand. Yeah.
I know you wouldn't want to be in business with Julie.
That's right.
Right?
That's right.
So
that's our wives. So if one of us passes, the others goes to the Yeah, I mean,
But you can agree. We can agree to put it in writing, and this is what we're going to do. And hey, so I've seen somewhere, it's a mandatory sale.
yeah,
Like, if I go, you got to buy my wife out at this value.
yeah,
I've seen where it's an option. Amy could stay in
that's right,
if I wanted her to.
right.
So,
And then
and
there's a
then
lot
that
of
may
time.
depend on whether you got kids kind of
In the
working in the
business.
business behind you. So
Yeah.
it's just different.
Yeah, and that is a typical scenario where it's 2 or 3 partners that have kind of
Yep.
built a business. A lot of times you see insurance paid for by the company
Life insurance, yeah,
that
helps fund those.
helps fund that.
Those,
Because you may not be sitting on that amount of money on the sidelines.
No.
Right. So
Typically not.
those are good, just kind of hygiene, I think, for businesses.
Yep.
If the goal of the business it would be continuity beyond one or both, or
Of the founders,
yeah,
say, yeah.
all good stuff. Any other things in your mind that we should touch on? I mean, we'll table all the deep dive into how to value a
valuations.
business, related to selling a business. I mean, what are some of maybe the concerns you hear from business owners when they are looking at selling? Anything strike you?
Well, one, finding the right buyer,
Yeah,
obviously maximizing your sales price,
Right.
But just finding a buyer. I think there have been instances, and probably in smaller businesses,
yeah,
where sometimes it's hard to find a buyer. You and I hear now there are people that want to buy.
right.
There are people that say they're in the market to buy businesses. We get calls every week about it, right?
Yep,
Hey, have you got anything that I got some money I want to?
yep.
But then when it gets down to it, sometimes it's hard to match
Yeah.
those up. So
Well, you really need, in an ideal scenario, you have either a management team or a management person that is in the industry that can come along with you, or you are that person and you're buying the business, because
Yep.
that's really where the matchmaking really has to happen. I mean, there's a lot of doctors where you can't just have anybody. I need to have, in a dentist practice, I need to have a dentist be able to come in and take me out.
yes, absolutely.
And, a lot of the strategies around that is, okay, I'm going to bring a younger dentist right out of school along, and we're going to agree on a 5-year plan or something like
Yep.
that. But you really do have to find the right person, and then when you kind of go back to some of these installment sales, you're betting on the person
Oh yeah,
or the people
Absolutely.
that are buying that company. So you want to make sure you have the right person.
I just thought we've been talking about having a session with a valuation person. There are firms, and we use them
Yep.
and work with them. All they do is buy and help people buy businesses and sell their businesses.
Right.
Right.
Yeah.
That may be a whole nother.
Yeah, that's right. Yeah, I mean, it is truly a process to kind of, again, you want to have a multiple year horizon.
Yep.
I think a lot of people push off this discussion because you're starting to talk about things you don't want to talk about.
You don't want to talk about. Yeah.
So it's like, am I 5 years away from retirement? If you are, and you don't have a plan and you're the business owner, you need to start getting a plan together, I think, for sure. Because look, there are going to be businesses that just don't find a succession plan, don't find an owner, that eventually you just go to the house and
Well, you either go to the house, the business closes, or something happens to the owner,
yeah,
and it's certainly devalued when the owner's gone.
right,
Typically.
yep.
Right. So yeah,
Yeah, you might only get the value of then just the assets. Like I
Be
just
no
want to
goodwill.
take,
yeah.
just want to take that line,
Yeah.
that equipment line or the forklifts and that kind of stuff. You're not
You don't want
maximizing
to. You don't want to
value
be.
there.
You don't want to be in that situation. And we've seen people, that have been in that situation.
Yeah.
Unfortunately.
That's right.
So to your point, be proactive, and if you have a plan for your retirement,
Right.
the succession of your business, then you need to have that well thought out
Yeah.
and start implementing it.
Yeah. I mean, and to your point that there are companies and businesses out there that really help business owners do that, and they do have that longer range. We're gonna put things in place for the next couple of years.
Here's you a plan
to
to maximize the value of your company, right?
That's right. And a lot of times when it is that retiring owner, normally founder, if you've already got management in place that can run the business, that helps a ton. I think that's
Absolutely, it does.
great little value kicker for when you're looking to remove yourself from it. If the business can then handle it, can be handled by the folks, because if you're like in that financial buyer scenario, they're not really looking to go hire, or they don't have.
And that
CEOs.
good management team is also a potential buyer.
Yeah,
I mean, we've seen
absolutely.
people, and that's typically where you see a lot of seller financing.
Yeah,
They know the people
That's
buying it because they've been working with them,
yep,
and that works pretty good.
yeah, and the employees, generally speaking, see less disruption and change in the day to day.
Yeah.
Which I think is also helpful.
So they're just all kind of ways to buy and sell
Yep. So if
businesses, because they're all kind of different. I mean, everything's different. Every company's different.
Yeah. So if you're one of those business owners that is thinking about whether now's the time to get out or 5 years from now is the time to get out.
If you're thinking about it, you need to start doing something about it.
Yeah, I think that's the
And that may have been where you were headed. But
yeah.
if you're starting to think about it, let's do something.
Let's get a plan together and start making proactive moves. Because when you wait is when you tick down that valuation chain every time.
Yep.
So any other things you want to add to the discussion? I mean, we got a pretty good discussion here.
Yeah. No, I mean, I think we've hit on we've hit high levels on a lot of things. If people want us to dig deeper, we certainly will. And we talked about it on valuations. I think it'd be good to talk about with an M&A company.
Yep, for sure.
Get their perspective.
Absolutely. All right. Well, great stuff today. I appreciate you.
Thanks for having me.
Yeah. Carl's always fun to do these with. We're going to have you on again for sure. Again, thank you guys for tuning in for the JMF Advisors Show. And if you have any questions about certainly selling your business or this podcast in general, or even have other topics that you'd like to hear on this podcast, please let us know at info@jmf.com, or you can certainly reach out to Carl or I. Thank you very much.
See you next time.
All righty. Take care.
Thanks.
Bye-bye. If you would like us to help your business or would like to suggest additional podcast topics, simply send an email to info@jmf.com.
And don't forget to subscribe to our podcast on YouTube and your favorite audio podcast apps.